Welcome back to our channel where we decode the mysteries of wealth building and financial strategy. Today we're diving deep into one of the most fascinating and controversial topics in personal finance: how the wealthy legally minimize their tax burden. If you've ever wondered how billionaires like Warren Buffett can pay a lower effective tax rate than their secretaries, or how some of the richest people in the world seem to pay almost nothing in taxes, you're in for an eye-opening journey. Before we begin, let me be crystal clear about something. Everything we're discussing today is completely legal. These aren't shady offshore schemes or tax evasion tactics that could land you in prison. These are legitimate strategies written into our tax code, often by design, to incentive certain behaviors and investments. The wealthy simply have the resources and knowledge to take full advantage of these opportunities. Now you might be asking yourself, why should I care about this if I'm not wealthy? Well, understanding these strategies serves two purposes. First, some of these tactics can be scaled down and applied to your own financial situation, regardless of your income level. Second, knowledge is power, and understanding how the system works gives you the tools to make better financial decisions and potentially build wealth yourself. Let's start with the fundamental principle that drives most wealthy tax strategies: the difference between income and wealth. Most people focus on earning more income, but the wealthy focus on building wealth. Why? Because income is heavily taxed, while wealth appreciation often isn't taxed until you sell, and sometimes not even then. Think about it this way. If you earn $100,000 in salary, you're going to pay income tax on that entire amount. But if you own a stock that goes up by $100,000 in value, you don't pay a penny in taxes unless you sell it. This is called unrealized capital gains, and it's the foundation of many wealthy tax strategies. The ultra-wealthy often structure their compensation to minimize regular income and maximize wealth building. Instead of taking large salaries, many CEOs and business owners take relatively modest salaries and receive most of their compensation in stock options or equity. This transforms what would be high-income tax situations into capital gains scenarios, which are taxed at much lower rates. But here's where it gets really interesting. The wealthy don't even need to sell their appreciated assets to access their value. They use something called the buy, borrow, die strategy. Let me break this down for you because it's absolutely brilliant in its simplicity. First, they buy assets that appreciate in value over time. This could be stocks, real estate, businesses, or other investments. As these assets grow in value, they don't generate taxable income because the gains are unrealized. Then, instead of selling these assets and paying capital gains taxes, they borrow against them. Banks are happy to lend money to wealthy individuals using their portfolios as collateral, often at very favorable interest rates. This borrowed money isn't considered income by the IRS, so it's completely tax-free. The wealthy can live off these loans, funding their lifestyle without ever paying income taxes. When they die, their heirs receive what's called a stepped-up basis on the inherited assets. This means the cost basis of the assets is reset to their current market value, effectively erasing all the capital gains that accumulated during the deceased person's lifetime. The heirs can then sell some of the assets to pay off the loans, often without owing any capital gains taxes because of the stepped-up basis. It's a cycle that can continue for generations, allowing families to build and preserve wealth while minimizing their tax obligations. Now let's talk about some other strategies that the wealthy employ. One of the most powerful tools in their arsenal is charitable giving, but not in the way you might think. The wealthy don't just write checks to charity and claim the deduction. They use sophisticated structures like charitable remainder trusts and donor-advised funds to maximize their tax benefits while maintaining some control over their assets. Here's how a charitable remainder trust works. Let's say a wealthy individual has stock worth $10 million that they purchased for $1 million. If they sell it outright, they'd owe capital gains taxes on the $9 million gain. Instead, they can donate the stock to a charitable remainder trust. The trust can then sell the stock without paying capital gains taxes because it's a tax-exempt entity. The trust pays the donor an income stream for life, typically 5 to 7% annually. When the donor dies, whatever remains in the trust goes to charity. The donor gets an immediate tax deduction based on the present value of the eventual charitable gift, avoids capital gains taxes, and receives income for life. It's a win-win-win situation. Another fascinating strategy involves something called opportunity zones. These are economically distressed areas designated by the government where investors can defer and potentially eliminate capital gains taxes by investing in qualified opportunity zone funds. The wealthy can take capital gains from other investments and roll them into these funds, deferring taxes for years and potentially eliminating them entirely if they hold the investment long enough. Real estate is another favorite playground for wealthy tax strategists. The tax code is incredibly generous to real estate investors, offering deductions for depreciation, mortgage interest, property taxes, and maintenance expenses. But here's the kicker. Depreciation is often a paper loss that doesn't reflect economic reality. A building might be appreciating in value, while the owner is claiming depreciation deductions that reduce their taxable income. Through something called a 1031 exchange, real estate investors can sell properties and roll the proceeds into new properties without paying capital gains taxes, as long as they follow specific rules and timelines. This allows them to continuously upgrade their real estate portfolio while deferring taxes indefinitely. The wealthy also make extensive use of retirement accounts, but not in the way most people think. While there are contribution limits for traditional and Roth IRAs, there are ways to get much larger amounts into these tax-advantaged accounts. Some have used strategies involving low-valued assets that later appreciate dramatically within the IRA, effectively sheltering millions of dollars from taxes. Business ownership provides another layer of tax advantages. Business owners can deduct legitimate business expenses, from home offices to business meals to travel expenses. They can also employ family members, shifting income to potentially lower tax brackets. Some establish multiple business entities to take advantage of various tax benefits and deductions. International strategies add another dimension to wealthy tax planning. While U.S. citizens are taxed on worldwide income, there are legal ways to minimize this burden. Some wealthy individuals establish residency in low-tax countries, though they must be careful to comply with U.S. tax laws regarding foreign residency and income reporting. Trust structures are incredibly powerful tools for the wealthy. Beyond charitable trusts, there are grantor trusts, generation skipping trusts, and various other structures that can minimize gift and estate taxes while preserving wealth for future generations. These trusts can be incredibly complex, but they offer significant tax advantages when properly structured and managed. Now, you might be thinking this all sounds incredibly complicated and expensive. You're right on both counts. Most of these strategies require significant upfront investment in legal and accounting fees, which is why they're primarily used by the wealthy. However, the principles behind many of these strategies can be applied at smaller scales. For example, you might not be able to afford a charitable remainder trust, but you can still maximize your charitable deductions through bunching, where you concentrate multiple years of charitable giving into one tax year to exceed the standard deduction threshold. You might not own a business empire, but if you have any self-employment income, you can take advantage of business deductions and retirement plan contributions. The key insight here is that the wealthy think differently about taxes. Instead of seeing taxes as an inevitable cost, they view them as an expense to be managed and minimized through careful planning and strategy. They invest in professional advice and complex structures because the tax savings often far exceed the costs. Understanding these strategies also highlights the importance of financial education and planning. The wealthy don't stumble into these tax advantages by accident. They work with teams of accountants, lawyers, and financial advisors to identify opportunities and implement strategies. They think long-term and are willing to accept complexity and upfront costs for significant future benefits. It's also worth noting that many of these strategies require significant wealth to implement effectively. You can't borrow against a stock portfolio if you don't have substantial assets to begin with. You can't benefit from carried interest rules if you're not a private equity or hedge fund manager. The system, in many ways, rewards those who already have wealth with additional opportunities to preserve and grow that wealth. This brings us to an important point about policy and fairness. Many argue that the tax code is inherently unfair because it provides more opportunities for the wealthy to minimize their tax burden. Others contend that these provisions serve important economic purposes, encouraging investment, charitable giving, and business formation. Regardless of your political views on tax policy, understanding how the system works gives you power. It helps you make better financial decisions, identify opportunities you might have missed, and potentially build wealth more effectively. The most important takeaway from today's discussion is that tax planning should be an integral part of your financial strategy, not an afterthought. The wealthy understand that it's not just about how much you make, but how much you keep. They structure their financial lives to maximize after-tax wealth, and you can apply these same principles at whatever level you're operating. Start by educating yourself about the tax advantages available to you right now. Maximize your retirement account contributions, understand the tax implications of your investment decisions, and consider working with a qualified tax professional as your financial situation becomes more complex. Remember, the goal isn't to avoid paying taxes entirely, but to ensure you're not paying more than you legally owe. The wealthy have teams of professionals helping them navigate these complex rules. And while you might not need that level of sophistication yet, you can still benefit from understanding the principles behind their strategies. As you build wealth, you'll have access to more sophisticated strategies, but the foundation starts with the same principles we've discussed today. Think long-term. Understand the difference between income and wealth. Use tax-advantaged accounts to their fullest extent, and never stop learning about the opportunities available to you. The secret sauce isn't really that secret after all. It's knowledge, planning, and the discipline to implement strategies that prioritize long-term wealth building over short-term gratification. The wealthy understand these principles and use them consistently. Now that you understand them too, you can start applying them to your own financial journey. Thanks for joining me today for this deep dive into wealthy tax strategies. If you found this valuable, make sure to subscribe and hit that notification bell for more content on building and preserving wealth.